Hi, good evening, everyone, and a warm welcome to our LLF Let's Learn Futures webinar series. We are thrilled to have each of you here with us today. And before we begin, please confirm in the chat box by typing yes or 111, or even share an emoticon if you can hear me clearly. Type a yes, 111, or share an emoticon if you can hear me clearly on your side. Great, thank you very much. I appreciate that. Now, today's Let's Learn Futures webinar topic is Mastering Momentum Trading. How to ride market waves like a pro. Now, this LRF webinar series is proudly brought to you by Bursa Malaysia in collaboration with Excellent. I'm CY Saw. I will be the moderator and speaker for today's session. I will be sharing with you about what is momentum trading, what are the types of momentum trading strategies, and what are the tools professional traders usually use for doing this kind of momentum trading. I see there are more people just joined in the webinar room. Welcome. One more time again, before we begin, let's do a quick final sound check. Please type in 111 or yes. Even give us a time up in the chat box if you can hear me clearly. And if needed, please adjust your volume settings to ensure optimal sound quality. Great, thank you very much. And to ensure you have the smoothest and highest quality video experience, I recommend turning off your video camera during the session, as this will help optimize and even minimize internet bandwidth usage and prevent interruptions, and also ensure an optimal learning experience for everyone. Today's session will be divided into two parts. The first part, I will present this sharing, and following that, we will be having a Q&A session where you can ask questions related to today's webinar topic. And there are some new improvements in this webinar platform. So if you would like to ask any question, you need to follow these three steps. Now, first, you need to find the Slido button. So if you're using your phone or laptop, somewhere on your lower right, you can find there's a three dot. Click on into it. Then there will be a message bar coming up. Search for Slido Q&A. Then you can type in your question in the message box as shown in number 3 area here. And of course, please note that due to the high volume of messages in the chat box, so later on in the Q&A session, it may be challenging for me to spot your questions if you don't use Slido for Q&A. So please, if you have any question, please type in your question in Slido box. As this LF Let's Learn Futures webinar series is brought to you by Bursa Malaysia, we have a lineup of exciting topics ahead to help you deepen your understanding of futures trading. Every Tuesday, we will host a new webinar topic in this series featuring sessions in English, Malay, and Mandarin. And our panel of speakers and experts will share their valuable knowledge and insights, and also practical strategies related to futures trading. We have many content-packed and informative topics lining up, with more being added regularly. So if you're interested in enhancing your knowledge and skills in futures trading, simply scan this QR code to register, and don't forget to add these sessions to your calendar so you don't miss any of them. Besides that, we also have the Let's Learn Futures online workshop. Now, this online workshop is specially designed for those who are new to futures trading. And in these workshops, we will cover a full set of beginners' knowledge in futures trading. It's a step-by-step guide to help you kickstart your first futures contract. And each session is 3 hours long. So the upcoming LLF online workshop session is next Saturday, conducted in Mandarin language, and the next upcoming online workshop will be next month, conducted in English. So you need to register quickly so that you are able to secure your seats. And please note that the attendance is limited to the first 50 online participants, so be sure to get your seats quickly. So once again, just let me briefly introduce myself. My name is Saw Chun Yan. You can just call me by my initial as CY. So first and foremost, my education background is in finance, and I started my career in the capital market, especially involving in trading and investment management. So I have been trading across different multiple time frames. So that includes intraday scalping, short-term trading to long-term value investing. And yes, I do specialize in technical analysis. I'm a chartered market technician. So not just only specialize in technical analysis, but also developing trading strategies and trading system, and also in trading psychology as well. Besides that, I'm also involved in hedging and risk management consultation, where I consult with companies to help them hedge and manage their commodity price risk and other financial risk. I'm also a corporate trainer providing upskilling training in different areas, such as management and leadership, communication, and so on. So, all right, before we begin, I would like to take a quick feel of, to understand who is actually here in our audience so that I can better tailor my sharing for today. So if you are completely new to trading, meaning if you have less than 1 year of trading experience in either stocks or futures, go ahead to type 0 in the chat box. And if you have been trading for 1 year or more, please type in 1 in the chat box. This will help me understand, whether, there's a mix of experience in the audience here, so that I can adjust my pace and the depth of my sharing for today accordingly. Okay, so if you have no less than 1 year trading experience, you can type in 0. If you have more than 1 year trading experience, you can just type in 1. Okay, let me have a look here. All right, it seems like we have quite a blended of equals, 0 and 1s here. All right, now, irregardless of whether if you are new in trading or whether you are, quite experienced in trading, whether in stocks or futures, at some point in your trading journey, you are bound to come across something what we call as momentum trading. So whether you're just starting out or have been in the stock market or futures market for some time, now momentum is actually one of those trading strategies that almost every trader encounters sooner or later. Why? Because momentum, this concept is actually very deeply rooted and it is actually one of the most observable behaviors in the market. Why? Because the price of whatever asset that you're trading, the price tends to follow strength, okay, at least for some time. So what that means is that momentum trading, it's all about capitalizing the trend, the strength of the trend. Okay, when you are able to identify assets that are moving in a particular direction, okay, when it is supported by trading volume and even volatility, and then you are riding that trend until there is a sign where exhaustion actually appears. So this is where trend starts to reverse and move the opposite direction. So momentum trading is based on a powerful principle, which is what we call, as the name implies, the keyword here is momentum. So this idea is simple yet effective. So to make it simple is that assets that have already moved in a particular direction, they are likely to continue to move in the same direction, okay, at least in the short term, okay, until the momentum begins to weaken. So later I will be explaining a little bit more in depth on that so that you will be able to understand what is momentum trading all about. Now, before we begin, I would like to give a quick disclaimer. This presentation is intended solely for educational purposes, and it should not be considered as investment advice or recommendation to buy or sell futures contract. So throughout today's webinar, I will be sharing with you some momentum trading strategies that can be applied within the context of futures trading. So what I will be covering today is intended as a set of reference points to enhance your understanding and refine your approach towards trading. With that being said, my hope is that today's session will help broaden your perspective and deepen your knowledge when it comes to different types of momentum trading strategies. Now, of course, your presence here today says a lot. It shows that you have some commitment to improve your trading performance and mastering momentum strategy. So whether you are a seasoned trainer aiming to fine-tune your approach, or you are just starting out looking to build a solid foundation, there's always something here for everyone. So in this session, I will be sharing some of the insights which are both practical and actionable. So no matter where you are on your trading journey, you will walk away with valuable takeaways that you can apply immediately in your trading. So today I will be dividing into 4 key topics that will, deepen your understanding of momentum trading. So the first topic, I will break down the philosophy behind momentum trading and explain why momentum trading works well in trending markets. Second topic, I will share a variety of momentum trading strategies that have been proven effective in real-world markets. Now, probably some of those momentum strategies you are currently practicing, it's just that you might not know it is actually a form of momentum strategies. Now, topic 3, I will walk you through some of the most common and popular tools and indicators that traders use when applying momentum strategies. And lastly, topic 4, we will explore how, when you incorporate fundamental analysis, this can help you create a more well-rounded and more robust trading strategy. So by the end of this topic, by the end of this webinar, you will have a deeper understanding of momentum trading strategies, and you will know exactly what tools and techniques to use to practice them more effectively. Now let's get started with our first topic. I will explain a little bit on the fundamentals behind momentum trading so that you are able to understand the underlying philosophy. And by the end of this topic, you have a clearer idea why momentum strategies are so effective in, especially in trending markets. So, what is momentum trading? Now, momentum trading is actually based on the momentum principle. Okay, it's a physics principle whereby assets, when they're actually in motion, when they are moving, they will tend to continue move. Okay, so in short, is that when an asset is actually in motion, they tend to stay in motion. So similarly, in trading, this means that once whatever product that you're trading, okay, whether is it stock or particular stocks or FCPO, FKLI, FSOI, when that asset it starts moving in a particular direction, then it is likely to continue in that same direction. Okay, because why? It will gain speed because more traders are actually joining in. So when it comes to momentum trading, it is actually, it is not just only a method of trading. It is actually, there are a lot of principles, philosophy behind, because there are underlying psychology about, the market behaviors of why momentum works so well. So later on, I will be sharing with you why momentum trading works well. But before that, you need to understand what is the concept of momentum first. Okay, so of momentum, of course, this concept comes from physics. So let me give you a few everyday examples to illustrate. So for example, I believe some of you, there will be some point in time where in your house or even in office, you would tend to try to push something heavy, right? Something like a heavy box, your bed, or even a sofa. So when you push a heavy box across the floor, initially it requires a lot of effort, a lot of strength for you to push first. Am I right? So once the box or that object starts to slide, it starts to moving a little bit. So as it gains and picks up speeds, you don't need to push as hard to keep it moving. So this is actually one example. Another example, okay, for example, pushing a car. So imagine you are pushing a car that is initially at rest. Of course, you need to make sure that the brake is actually released. So it's tough to get it moving because of inertia, because your car is actually resting. But once the car is slightly moving a little bit, okay, once it starts rolling, as it picks up speeds, it's easier for you to push the car with very minimal effort. Another example, which is a snowball rolling down the hill. So of course you might be seeing a lot of cartoons and even geography or documentary, right? So you can see that when a small snowball rolling down a hill, okay, as it gains speeds, it picks up more snow and growing larger and moving faster. So all of these are several examples to illustrate what we mean by momentum. So in trading, once an asset, okay, if the price is not moving, so which means it is at inertia, it is resting. But once the asset price, it is start trending in a particular direction, once it start picking up speed, it will tend to keep moving in that direction more easily, whether is it an uptrend or a downtrend. So it will be gaining strength until something else disrupt the trend. So momentum traders will be actually looking at these trends to capitalize this opportunity by riding the wave until there is a sign of a reversal appears. All right. So to make it simple, momentum trading is when traders focus on buying assets that are already going up in price. Okay, the keyword here is already going up or going down in price. So when price going up, they will be taking a long position in the market. If the asset price is actually going down, then they will be taking a short position in the market. So the idea is that if something is moving in a certain direction, then it is likely to keep moving that way for a while. So if an so if it is an uptrend, okay, the uptrend will likely continue for a while, whether is it days, weeks, or even months. If it is a downtrend, then the downtrend will likely to continue for days, weeks, or even months as well. So this is oftentimes driven by market psychology. Basically, what we mean by market psychology is actually, all of the market participants that is involving in trading that particular asset, whether is it index futures or even commodity futures. So when traders get excited and greedy, okay, they buy more, they push price even higher. And when they get panic or even get fearful, they sell, causing prices to drop. So for example, like yesterday, what we call as a Black Monday for this year, where the FKRI has been dropped by more than 60 points. So instead of trying to figure out the true value or intrinsic value of the asset by doing any valuation, when we do momentum trading, okay, momentum traders, they typically they are more interested in actually using charts, trading volume, uh, to understand how much it is being sold or buy, and even price changes to decide whether they want to take a long position or short position, whether they want to buy or sell. So all of these tools help them to spot trends and make decisions whether to jump in or get out from the market, hoping to profit from the movement while there is still momentum in that particular direction. All right. So if so far you are able to follow me, you can type in OK in the chat box so that I know uh, at least the basic momentum principle you get it so far. All right. So once you understand the principle, how it works, now here I would like to share with you why momentum trading actually works. Few things. Number one is actually market psychology and herd behavior. Now, traders and investors, they often follow the crowd. Am I right? So when price rise, more people jump in, pushing price even higher. Then another batch of people see the price goes up. They also follow the crowd together. Okay, so irregardless of what trading tools, what trading styles they use, when you see trend move in a particular direction, right, you will also tend to follow accordingly, follow with the trend, right? So on the flip side, during a downtrend, so this is where panic selling intensifies. So this causes price to come down, pushing price down even faster, like yesterday. Okay, market down very large, and then people are very panic. So the market participants again join the crowd, causing the price to go down even further. So to make it simple, traders often follow trends based on fear and greed. So this is actually the fuel that fuels momentum moving on. So when the asset, when it gains traction, more investors actually jump in, pushing price even further, whether is it an uptrend or a downtrend. Now, the second reason is actually trend continuation. So as an asset, they begin to trend in one direction. So this often gives it gains visibility from others. So the more it moves, more traders are becoming more aware about it. So which in turn it will draw more participants into that direction. So this increased buying or even selling pressures, pushing the price trend even further. So in this way, trend don't just only continue, they also accelerate as well because momentum itself attracts more traders. Okay, the speed is it will gain faster and faster. Now, the third reason is actually institutional and also algorithmic trading influence. Now, of course, those large institutions, hedge funds, and even nowadays we have a lot of algo traders. Am I right? So they will be using quantitative models, or even those who are doing automated trading, they will be using quantitative models, and these quantitative models, most of it will be actually using some sort of momentum uh, trading models. So whenever there is a trigger for a price trend, so again, they will also become one of the market participants to join in the market and then causing the price to move as well. Okay, so you can see why momentum trading is actually quite popular in the market. And lastly, market anomalies and trend persistent. Now, in finance, there is research saying that momentum and anomalies, because why? Markets sometimes they don't always react perfectly towards new information, and this can actually cause strong trends to last longer than expected. So in behavioral finance, there is a study shows that traders oftentimes they underreact to new information at first, but then later on, they overreact towards that information. So this is where they push trends further and extending the momentum and accelerate the momentum as well. So that explains why usually at the beginning of a new trend, whether is it uptrend or a downtrend, okay, the beginning of a trend, the speed is usually slow, okay, because people don't really notice it that much, right? So when the speed is slow, the price movements are also small. Then as it slowly picks up speed, so momentum increase, then the trend moves even faster. Price movements are getting bigger. So you can see there would be a very clear trend. So there will be, it attracts more traders and investors to, tag along with the market. So of course, with these four key reasons, you will notice why momentum trading is actually quite popular among the trading community. And of course, there are several important notes that you must know is that, which is liquidity and volatility. If you want to do momentum trading, it is actually works best in a market where the asset is very highly liquid, where you can buy and sell very easily without affecting the price too much. So for example, popular futures products like FKLI, FCPO, they are highly liquid. So it actually fulfills this required criteria. Secondly, is actually on volatility. Now, doing momentum trading means you will be riding on high volatility. You are riding on high speed. So when price moves up and down a lot, so this you will be experiencing high volatility. So of course, there will be chance for you to make more profit. However, this also means there will be a chance for you to make more losses. There will be risk as well. Okay, so the risk and return trades off, it's always there. High risk means high return, low risk means low return. So momentum trading is when the price swing can be high and sometimes not predictable. So it's important for you to manage your trading risks also. Now, when does momentum trading works best? Very simple. Momentum trading works best during strong trending markets, whether it's a bull market, bear markets, or high volume market conditions. Now, in bull markets, during a strong upward trend, it creates opportunity for you to buy and ride the momentum when price is actually rising. So this is actually ideal for momentum breakout strategies where asset breaks through resistance level and it continues to rise. Whereas for bear markets, okay, momentum trading can also work well in during downtrend, particularly by short selling when the price comes down. So this is actually for those of you who haven't begun futures trading yet, you will see that this is actually one of the advantage of trading futures is that you can take a short position in the futures market. Okay, you don't have to own anything. You can immediately take a short position in the futures market and taking advantage when the price comes down. So traders can capitalize on panic-driven sell-off when price breaks down your below your key support levels. Now, in high volume market conditions, of course, momentum trading, you need to fulfill this criteria as well. You need to make sure that the trading volume is high so that you are able to confirm that the price trends and reduce the chances of actually those false breakout. False breakout means the price breaks up or down for a short moment and then the price goes back the opposite direction again. So when you have high volume, so very likely that the trend will continue to move in a particular direction. Okay, so to make it short and simple is that high volume is actually more reliable when it moves in a particular direction. If there is low volume, so your trend might not be strong enough. Okay, so momentum surge are often triggered by those new catalysts, new fundamental change, or even significant economic events. And lastly, there will be one situation where momentum trading does not work well, which is sideways or choppy markets. So this is also one thing that you must know if you're practicing momentum trading strategies. Momentum trading is less effective in sideways markets, range-bound markets, or even choppy markets. This is where your price moves, sideways or within a small tight bandwidth. Why? Is because it lacks of clear direction. So false signals and erratic price movements like whipsaws commonly found during these conditions, and this will often leads to your cut loss getting stopped out very easily, and you will have a lot of frequent multiple losses. So to make it to summarize, the first topic is that you need to understand momentum trading. It works by capitalizing on market trends driven by psychology, market psychology, liquidity, and volatility. So oftentimes traders focus on assets that are already moving in a clear direction, either upward or downward trend, and they aim to ride on this trend to profit from it. And momentum trading works well in strong trending markets, whether it's a bullish market when price is rising, bearish market when falling prices, because momentum will continue to build in that direction of the trend. All right. And when you do momentum trading, please try to avoid range bound markets because it is very least effective. Now, second topic, once you understand the foundations of momentum trading, here I'm going to share with you some of a few strategies that is considered in momentum trading as well. There are many momentum trading strategies. Each strategy has its own name, okay, regardless of what name that you want to name it. And each strategies, they have their own tools for identifying opportunities as well. Okay, it has its own criteria for entering and exit. However, all of these strategies can be grouped into four main categories. All right, and these core strategies form the foundation of momentum trading and are adaptable to different market conditions. So in this section, we are going to explore some of the most effective momentum strategies. So we have breakout trading, trend following, pullback, and momentum divergence. Now, a quick question for you. Which of these strategies that you are currently using in your trading? If you're using breakout trading, you can just type in 1 in the chat box. If you're using 2, you can type in 2. If you're using, combination of it, you can type in a few figures in the chat box as well, so that at least I know what kind of trading that you are currently practicing. All right, I see majority of you doing trend following, minority doing breakout trading, some of you doing pullback. Okay, very good. Any one of you doing combination of those? If you have combination, you can type in a few figures in it as well. All right, so most of you doing either one of these two forms. Okay, so at least in this session, you understand that, irregardless of, either of these 4 strategies that you use, right, it is also classified as momentum strategies. Even if you're doing trend following, it is also considered as a form of momentum strategies. Later on, I'm going to explain it to you why trend following is also momentum strategies. Now, let's have a look at each and every of these strategies. I'm going to briefly introduce you on that. Now, the first strategy, momentum strategy, is what we call as breakout trading. Now, sometimes people will call this strategy as a form of strategy that can have an explosive move. Okay, explosive move means once you enter, right, you may be expecting, within a very short duration, the price movement, you immediately can see result almost instantly in within 1 or 2 days. Okay, the price continue to move in a particular direction. So this is what we call as the breakout trading. So what is breakout trading? This is actually one of the most commonly used momentum strategies, and oftentimes when people talk about momentum trading or momentum strategies, they usually refer to breakout trading method. All right, so even if you refer to different books, websites, or videos or other things, more than 80 to 90%, they are actually referring to breakout trading. Now, breakout trading is actually one of the strategy where traders enter a position when the price, uh, they moves beyond a key level of support or resistance, okay, accompanied with a surge in volume. So this actually signals the beginning of a strong trend, and oftentimes this offers traders an opportunity to capitalize on the momentum, so which is why there will be explosive moves quite instantly. So how do you actually trade momentum breakouts? So very simple. Firstly, of course, you need to have some basic knowledge of technical analysis. You need to be able to identify key support and resistance level first. So during an uptrend, you need to look for resistance, which is your price ceiling. Okay, if you're trading for a downtrend, you need to look at the support level, where price has, historically struggled to have a breakthrough, whether is it a fail breakthrough towards upwards or downwards. So why is this important? Because these levels are very critical in spotting potential breakouts. So when you are identifying key levels, so there are plenty of those. So later on, I'm going to share with you. Now, secondly, is that you need to confirm with volume. So a breakout that usually accompanied with high trading volume, this actually confirms the move strength. Okay, a breakout with low volume, they may be signaling a false signal and lead to a reversal. So let me give you an example. What do we mean by confirmation of volume? So it's like, uh, a general and soldiers. So if a general, they themselves, right, alone go in front forward, okay, or general go attack alone. So which means they have less troops. So when you have less troops means your support is not strong enough. So just imagine during an uptrend, one bull is going up only instead of 10 bulls. So the strength of a bull market may not be strong. The more bull is actually, leading the upward movements, right, then the trend would be more reliable. Similarly, for downward movement, if only one bear very few bear is actually leading the downtrend, it is not strong enough. You need to have a lot of bears joining in as well. So confirmation of volume is also important. Now, when you are able to identify key levels and confirmation with volume, the next thing is that you need to find an entry point. So how you do that later on, I'm going to give you some examples. So when you set an entry point is that you enter a trade when the price closes above your resistance level. So this indicates a bullish breakout, or below support level. So this indicates a bearish breakout. So of course, some traders prefer entering on a retest of a breakout. So that is actually the another form of trading, is what we call as the pullback. But right now we focus on the breakout method first. All right. And of course, lastly, it's very important for you to set your stop loss and also your profit taking. So let's have a quick look at this example. Now, firstly, if you look at this chart, right, we need to identify what is the key levels first. So of course, very simple, you just draw a horizontal line. Okay, here we can identify what is the resistance level. So secondly, you just need to wait, okay, when the price breaks out the key resistance level. So there is the opportunity for you to enter the market with a long position. Okay, long position means you will be taking advantage when the price goes up. And when you enter the market, of course, you need to set your stop loss level using the recent support level. Okay, there are many different ways to set your stop loss level. So one of the way is actually using the recent support level. Then what you need to do is that the last thing is that you need to have patience. Okay, you need to patiently wait until the trend forms. If the price goes up, congratulations, you are riding the trend, you make a profit. Now, if you take a long position and the price goes down, you make a loss. So what you need to do is that you need to cut your losses short and get out of that position. Okay, this means it's a false breakout. Your hypothesis for an uptrend is actually it does not hold. Now, another example, the same chart as well. First, you need to identify the key level. So let's say just now you missed the first opportunity to enter the market. So you identify the next key resistance level. Okay, so you draw a horizontal line. So here you can see that there is another opportunity. When price breaks out the key resistance level, and there is another opportunity for you to enter the market with a long position. So here what you can do is you enter a long position on this particular day, and of course you need to set a stop loss. Okay, there are many ways to setting a stop loss. Okay, you can use a recent support, or sometimes you can use indicator, or you can use the day low or few days low itself. Okay, there are plenty of ways for you to do that. So again, what you need to do next is that you need to be patient until the trend forms. Okay, you can see that, once you enter, you still need to wait until the trend forms. If the price goes up, you ride on with the trend, you make a profit. If the price goes down, you make a loss. So you need to cut your losses short and get out from it. So here you can see that for breakout trading method, whenever the price breaks out the key resistance level, or even the support level, you immediately can see the price movement swing can be very fast, huge price movement, and almost immediately, within less than a week, sometimes even 1 or 2 days, you can see results. Either you are making a profit or you are making a loss. Okay, so this is usually what we mean by momentum trading. Most people refer momentum trading is actually, they are referring to high momentum trading. High momentum means high speed trading. Okay, the market is actually moving at a high speed already. Now, another example, how about entry for breakout on a support level? So same chart as well. This is actually our recent chart for the FCPO market. So again, you identify your key levels, your support level. Secondly, you are able to see, when the price breaks your support level, what you need to do is that you enter a short position, and next you need to do, again, you need to set your stop loss level using the recent resistance level. So what the next thing what you need to do is, again, you need to be patiently wait until the trend forms. Okay, if the price goes down, you ride on with the trend, you make a profit. If the price goes up, you make a loss. You need to cut your losses short and get out of the market immediately. All right, so this is actually a momentum trading. Immediately, almost immediately, you can see the results. Now, the second type of momentum trading is what we call as the trend following. So of course, this is where you are riding the momentum wave. Now, momentum trading, later on, I will highlight what are the difference between trend following and momentum trading. Now, of course, for those of you who are very familiar with trend following, sometimes we call it trend trading. Okay, it's actually an interchangeable words. Now, trend following means most people don't see this trend following as a form of momentum trading. Why? But but for me, trend trading, you can classify as momentum trading. However, this form of momentum, it is actually at a slower speed, okay, at a slower momentum. So later on, when you look at the chart, you can see how slow is slow that I'm referring to, okay? Now, trend following is a strategy where traders enter position in the direction of an established trend. So they aim to ride on the momentum until the signs of reversal appears. So this approach is typically medium to long term, and it requires patience also. So as you will be holding your positions for an extended period by riding the whole trend. So again, what you need to do is that how you do trend trading, very simple, same thing as momentum trading. You need to be able to identify the trend first. So of course, preferably a strong trend. The next thing you need to do is that you need to confirm whether the trend is actually strong or not. So you can use other tools like MACD or RSI to identify whether there is a bullish momentum or a bearish momentum. So later on in the next topic, I will share more about indicator in the next topic. Thirdly, you can also, if you're doing trend following, you can enter on breakouts or also pullbacks as well. Okay. And lastly, when you exit, you will exit when the trend reverses. So what do we mean by that? So let's have a look at this chart. In this example, we will be using moving average indicator to identify a trend. So for those of you who are really familiar with moving average, is that when price is above moving average, it means an uptrend. When price is below moving average line, it means a downtrend. Now, one thing you need to understand moving average is that this moving average line can also act as a support and resistance line. Okay, so when price breaks out above your moving average resistance line, it is an uptrend. When it breaks down the line, support line, it means it is a downtrend. So likewise is that, in this example, price breaks above your moving average line, breaks your resistance line already. So this is where you can actually enter a long position, hoping that the price is actually will be trending out. So again, you can set your stop loss using the moving average line itself. So again, what you need to do is that you need to be patient and ride along the trend. Okay. Now, good thing about using technical indicator is that you know when and where to exit your trade. So unlike the breakout method, generally speaking, you need to find your own entry and exit manually. So how do we exit for trend following method is that you can exit when the price breaks below your moving average line, which is a support line. So this is the place where you exit the market, or in other words, you can also enter a short position because the downward momentum is actually begin. Okay, the upward momentum is already losing its steam, and the downtrend is beginning. The downward momentum is picking up. So this is on trend following. The third method is on pullback strategy. In other words, sometimes we call it buying a dip during an uptrend or during a downtrend. So this actually involves entering a position after a temporary price dip or price pullback in an ongoing trend. Now, this strategy allows traders giving you, additional opportunity to buy or sell in a more favorable price during a pullback. So this also, you are able to capitalize on the overall momentum of the trend. So this actually makes it easy, to make it easy for you to understand is that when you do pullback trading means you have already know the trend. So which means you already know it is an uptrend. You are just finding an opportunity to enter the uptrend. You already know there is a downtrend. You just find an additional opportunity to capture the downtrend. Okay, so this is what we mean by the pullback trading. So again, very simple. You need to find the trending patterns. You need to also identify whether there are key support levels or resistance levels. Again, you need to look at whether there is a bullish or bearish reversal signals. And then when you enter a trade, you need to enter with a stop loss protection as well. So again, back to this example with a moving average. So let's say on the far right hand side, you can see if you met, let's say if you miss the first move, okay, when there's a price breaks above your moving average, you miss that first round already. So what you can do is that, you already know it is an uptrend. You want to find whether there is the next opportunity for you to enter an uptrend or not. So here you can see, okay, when the price comes back down again, there is a pullback. So you need to be able to identify if there is any opportunity for you to enter a long position. So after the price pulls back down again, so price goes up, you can see this is one form of candlestick formation, which means engulfing. The green candle is actually bigger than the left hand side red candle. So it almost engulfing means it's actually eating up the red candle. So this gives you an additional opportunity for you to enter a long position. Once you enter a long position, of course, you need to be able to set your stop loss. Okay. Now, for pullback trading and breakout trading, usually the stop loss will be setting at the most recent support or the recent resistance level. Why is that so? Is because you do not want to amplify your losses further. You want to the recent key level support key levels or resistance key levels is actually an indication for you to support your decision to move in a particular trend. So if price, let's say, move the opposite direction, okay, in this case, if the price comes down, so at least you know where to cut your losses short and completely get out from the market. All right. So once you are enter this particular trend, all you need to do is, again, you need to have patience to ride along the trend. Okay. So again, if you want to do this, continue with trend following, you can exit the trend based on moving average itself. How about this? Same thing, without moving average, you also can do your pullback trading. But of course, you need to use another different kind of tools for you to make your trading decision. So in this case, you can have a combination of using candlestick confirmation for you to support your decision whether to enter the pullback trading or not. All right. Now, another example, which is also entering on pullback. So let's say just now, if you miss that trade for the same chart, again, there is another an opportunity for you to do your trading. So this is where you can actually using drawing support and resistance line. So this is a little bit slopey line. It is what we call as a wedges formation, or sometimes you might be calling it a triangle formation. So here you can see that the price is actually breaking above your resistance line. So this is where it shows it indicates an uptrend already. So you can enter a long position if the price breaks above the line. If the price breaks below the support line, you enter a short position. So in this case, price is above the line, you enter a long position. So how you set your stop loss? You take your recent support level as your stop loss. Okay, and again, what you need to do is actually ride on along with the trend. So this is what we mean by a pullback strategy. Okay. Again, another pullback strategy is you can actually draw a trend line. Another opportunity for you to do that is that when price touches the trend line again, so this is where you hope that the price will bounce back up when the price hits your support line. Okay, so what you need to do is that, again, you can enter that particular trade with a combination of candlestick formation, your stop loss will be setting at the recent support level, or even using your trend line as a support level. All right, so this is on pullback trading. And lastly, on momentum divergence. Now, this one, if you are very new in trading, I do not encourage you to do this kind of trading, because this is a little bit high risk of trading. But this is also another form of momentum trading. Now, what is momentum divergence? Divergence here, it actually happens when the price of an asset moves in one direction, but your momentum indicator, like your RSI or MACD, moves in the opposite direction. So this often signals a potential trend reversal. So this will be providing you an opportunity to enter before the market fully changes the direction. Okay, so we have a bullish divergence when price is actually having a lower low, but your momentum indicator RSI MACD is actually forming a higher lows. Whereas for bearish divergence, your price forms a higher highs, but your no, not higher highs, lower highs, but your RSI and MACD forms lower highs. Okay, so this actually is suggesting a bearish divergence. Your upward momentum is actually weakening. Okay, so it's easier for you to look at the a chart for you to understand here. All right, so how to trade this is that you need to wait for confirmation when your trend line breaks, or there is a reversal for your candlestick patterns. So oftentimes when traders do momentum divergence, right, it's actually a combination of pullback trading and also trend trading. So you will be looking at both trend and also momentum indicators, two indicators at the same time. So how do we do momentum divergence in trading? Is that here you can see, for example, now divergence in MACD is that you can see on top your price is actually getting lower, whereas if you stretch looking at the longer term, right, you can see your MACD is actually having a higher lows. So this indicates that the downtrend, there is a potential reversal of downtrend, and there would be a beginning of an uptrend. So this is what we call as a bullish divergence. Okay, so you can see at this particular dotted line here, so when the price is actually the line is above the MACD line, then the price is actually trending upwards. Another example is you can see on the right hand side, when the price is actually getting lower highs, but your MACD is actually showing lower highs. Okay, so this actually indicates that there is another form of special divergence. So it indicates that the uptrend, it's almost losing its steam already. So it's like when you throw your ball up, right? Although your ball is still going up higher, but it's actually the strength, the speed of going up is actually getting lower. So which means the ball is about to have a U-turn direction already. So this is what we call it in divergence in MACD. How about divergence in RSI? Same thing. You can see, the price and your indicator is actually moving two different direction. One is moving up, the other is moving down. So it indicates a price change. Okay. The second point here, you can see price going slightly downwards. Your RSI is sloping up. It's another divergence. And the third one, uh, price about the same level, but your RSI is actually trending downwards, so it's a divergence. And the last one would be price slightly move higher, but your RSI, it's actually have a lower highs. All right, so this is also another form of divergence. So divergence in RSIs, usually we will be looking at a longer time frame, so that you are able to make a comparison whether the momentum is actually strengthening, or when the momentum is actually weakening. All right, so just a quick summary for all these four categories of momentum trading. So to make it simple, breakout trading is ideal for catching explosive move, but it requires confirmation to avoid false breakouts. Trend following allows you to ride on your momentum, but this trend following is actually on a slow momentum before there is a fast momentum. So if you're doing trend following, you need to have even greater patience and discipline to ride along with the trend. Whereas for pullback trading, it helps you to enter at a better price in case you miss on the first opportunity. So you still have another second, third, or even fourth time opportunity, or it depends on how strong is the trend. All right, if the trend has a lot of opportunities for you to re-enter a particular trade, so this is actually on pullback trading. Whereas for divergence trading, usually this is what we will be doing, is actually a trend reversal. So this is also another form of momentum strategy. So if you are very new in trading, if you haven't gained any consistency in gaining profitable results in trading yet, please do not do any divergence trading yet, because this is still considered as a high risk. Now, in this topic, I'm going to share with you some fundamentals of trading tools, because different trading tools has its own purpose. So it's just like a professional carpenter. A carpenter has a lot of tools in their toolbox in order to make a furniture. A professional chef has a lot of kitchen utensils and equipments to craft their dish right. So likewise, for a professional trader, they have a lot of tools in their toolbox to help them to trade. So momentum trading relies heavily on technical indicators and tools to help traders to measure price strength, to identify trends, and also confirm signals. If you are doing naked chart trading, right, usually naked chart trading, it's you are not able to identify momentum. So usually momentum trading, you still need some form of technical indicators and other tools um, to help you confirm a reliable signal. All right, so all of these tools are essential for you to make informed decision, so that you are able to successfully, capture the market momentum. And in this section, we are going to explore some of the most effective momentum trading indicators and tools, and how to use them, and how you can actually combine them for optimal results. Because of time limitation, I'm not going to go through all, but some popular tools that are simple and practical in its application. All right, so you can see we have three categories, from price patterns to drawing of lines like support and resistance lines, as well as technical indicators. Now let's have a look at the first indicator, which is moving average. I believe you are quite familiar with this, because moving average are actually tools to smooth out price action based on the average price data over a specific period. And they help traders to identify the overall trend by reducing noise and providing you a clearer view of the market's direction. So we have simple moving average, we have exponential moving average. Okay, both of them having the same purpose, it's just the calculation is slightly different only. Simple moving average focuses on the is less responsive to recent price changes, because it plays equal weightage for all of the price data. Whereas for exponential moving average, they place more weights on recent prices, so making it more responsive to price movement. However, it is sometimes, some traders, they don't like EMA because it might be a little bit too sensitive towards especially during choppy markets. Anyway, both moving average, okay, simple SMA or EMA, both are also ideal for momentum trading. Now, you can either use one moving average or double moving average for trading. So for a bullish trend, it's when your price is above, let's say 50 days, 100 days, or even 20 days, okay, depending on which moving average parameter that use. Any parameters are fine. So of course, you can back test and fine tune your parameters to have an optimized parameter for you to do your momentum trading. The criteria for bearish trend, if you're using simple moving average, is when the price is below your moving average line. When you use double moving average, now the criteria, it's slightly different already. It's when you comparing with both moving average, which means your fast moving average has to be above your slow moving average for a bullish trend. Whereas for a bearish trend, your fast moving average, okay, for example, in this case, 20 days have to be below your uh, slow moving average. All right. Now, an example here, one moving average, you can see is that it's very simple for you to make a trading decision. So here you can see when the price breaks above your moving average, it is an uptrend. Price breaks below your moving average, it will be considered as a downtrend already. When you use double moving average, so the red line is your fast moving average, blue line is your slow moving average. So when the red line fast moving average is above your slow moving average, it is considered as an uptrend. So it's somewhere here, starting at this point. Whereas this whole area would be an uptrend. Whereas for a downtrend is when the criteria is when your red line crosses your blue line. Your fast moving average is below your slow moving average. So your downtrend is actually starting at this point onwards. Okay, so this point until to your right hand side will be considered as a downtrend. Now for FK outline market, again, you can also use two moving averages to determine whether it is an uptrend or downtrend. So on the far left hand side, when the red line is above the blue line, fast is above your slow moving average, this whole area would be considered as an uptrend. When your fast moving average is below your slow moving average line, it is considered as a downtrend. So I believe most of you are quite familiar with this already. Now another one would be that I would like to introduce is actually Donchian channel. Now if you would like to know about more Donchian channel, you can actually search Google search on it, because this is actually this indicator is popularized by those turtle traders, because turtle traders in the initial stage they are using Donchian channels to do their trend following methods. And of course this Donchian channel is actually, yes, they are also a form of trend following indicator that actually plots the highest high and the lowest low over a specific period of time. So usually the standard parameter would be using actually 20 days. So Donchian channels is very good to spot breakouts, trends, as well as volatility expansion. So this actually helps traders to set entry and exit points. So let me go through a quick one on the chart itself so that you understand how it actually works. So for example, you can see that, whenever the line moving horizontal, right, when the price is actually crosses above your left hand side line, okay, so it means there is actually a form of breakout already. And of course, this Donchian channel, you don't have to draw it by yourself. It is an indicator, right? So when you plot this indicator, all of this line will be coming out automatically. So when price breaks out your horizontal line, it means price is actually moving in a specific direction. So if it breaks out the upper line, upper channel, it means it's an uptrend. If it breaks down the lower line, for example, on the right hand side, in this case, the red price is actually breaking down the horizontal line, it means it is a downtrend moving forwards. So this is breaking upwards means it's a bullish momentum. Breaking downwards, it's a bearish momentum. Now, MACD. So, of course, I believe some of you are quite familiar with MACD. Of course, MACD here, it's a special indicator. It is not just only talking about the direction of the trend. MACD is specifically, it tracks momentum by comparing two moving average line, and it identifies the shift in your trend strength. So it has three components: MACD line, signal line, and histogram. Now here there are a lot, at least three ways for you to use MACD in momentum trading. We have MACD crossover, we have a zero line crossover, and divergence. However, in this session, I would like to specifically highlight what is zero line crossover. Okay, when you do this zero line crossover, you can minimize a lot of your trading risk. Okay, now very simple. Okay, zero line crossover. If your MACD line, okay, it's above your zero level, it means it is an upward momentum. If a MACD line moves below your zero level, it means it is a downward momentum. As simple as that. All right, let's have a look at this chart. So you can see on the left hand side, bottom is actually your MACD indicator. So you can see the MACD line is actually above your zero. Okay, MACD line in between, there will be always a zero level here. So when price is above zero, it means it is an uptrend. When your line is again above zero, it is always an uptrend. However, when your MACD line, especially the fast line, right? Okay, the red line, the blue line, the fast MACD line, it's below, crosses the zero level. So this is where downtrend already begins. Okay, so this whole area would be considered as a downtrend. So I understand that MACD has a lot of criteria and rules, but the very easy for a lot of you to able to identify and very easily applicable is actually follow the zero uh, level principle. Okay, zero, above zero means it is a bullish, below zero, it means it is a bearish situation. Now, another situation for your FKR line. Above line above MACD zero level, it is considered as bullish. Above zero is bullish, and again below zero is actually all considered as bearish. Okay, so you can see the FKRI has been bearish very earlier on. Okay, you don't have to look at, you know, although in between there may be ups and downs, but as long as you know, MACD line is below zero, it will be considered as a bearish momentum. So you can see one good thing about using momentum indicator is that it gives you a different signal compared to those trend indicator. RSI, again, very simple. Now, to cut long story short, RSI, I believe you understand how it works. It is actually an oscillator, so the line will be moving around 0 to 100. So to make it simple, there are different approach for you to use your RSI for momentum trading. So here, what I want to introduce you is actually you use the 50% level rule. Okay, so this example, this rule is actually very simple. It's exactly the same as the MACD zero level rule. Okay, so what it means is that when your RSI is above 50, it means it is a bullish, it is an uptrend. When your RSI is below 50, it is a bearish momentum, it is a downtrend. So let's have a look at the price chart here. So on the left, you can see when the RSI it's above your 50 level, it is considered as an uptrend. Below 50 would be considered as a downtrend, this area. Okay, you can see again, and that I highlight out. Uptrend, it's a line above 50. Uptrend line above 50. When line RSI line is below 50, it is considered as a downtrend. So during a downtrend, do take a, you know, find opportunities to take a short position. During an uptrend, find an opportunity to take a long position. All right, so this rule is actually very easy for almost all of you to apply. Another example, as long as price RSI is above line 50 level, it is considered as uptrend. Above 50 uptrend, above 50 uptrend. RSI below 50, you can see it's already beginning of a downtrend. RSI below 50, it is a downtrend. Okay, so all of this RSI gives you a very different indication about the strength of a particular trend. All right, and lastly on volume analysis. Now I would want to highlight the key thing about volume here is that in futures market, volume actually measures about the number of contract that is traded in a given period. So of course it plays a crucial role in confirming the strength of your momentum. So it gives you a price, strong price movement are all usually accompanied with high volume, while a weak price movement have a low volume, making them less reliable. So of course, usually when we trade futures, besides volume, we would also want to look at open interest, which tracks the total number of outstanding contracts, which is, you know, it will be able to providing you a better measurement of market participant rather than volume alone. Now, one thing I want to highlight to you is that the use of volume, you need to see whether volume or an operant interest are practical enough for you to apply whichever product that you are trading. Okay, now let's have a look at this FCPO market. Now, if you look at this FCPO, you can see volume. There is a pattern here. Volume usually spikes during the middle of the month. Now, this happens because most of the traders, they tend to roll over their contract to the third active month. So volume in this case is not quite practical in the usage for FCPO. So you can ignore volume here. Now let's have a look at FKLI. Now I believe immediately with an immediate glance, right, you can see there is a volume pattern here. Now volume usually spikes near the end of the month. Now this happens because most traders, again, they tend to roll over their spot month contract over to the next month contract. So again, volume in this case, it's not reliable. It's not quite practical in the usage for FKLI. So to make it to make your trading a little bit simple, you don't have to use volume to trade in to do your momentum trading, at least in Malaysia futures market. All right, so to quickly summarize is that for doing momentum trading, you can combine multiple indicators together to confirm your momentum strength. You can use 2 combination or 3 combinations of indicator, that's fine. Now, lastly, which is on combining fundamentals with momentum to create a winning strategy. Now, of course, momentum trading in Malaysia futures market, specifically with instruments like FKLI and FCPO, can be significantly enhanced when you incorporate fundamental analysis alongside with technical strategies. So, technical analysis, it's useful to identify precise entry and exit point based on market patterns, and fundamental analysis ensures that you are aligned with the broader market forces that drive the price movements. So these 2 combinations improve your trade accuracy and can lead to a more profitable outcomes. So in this section, we will briefly explore how integrating fundamental analysis with momentum trading strategies for FKLI and FCPO markets. All right, so to make it's simple because of time limitations. So I would like to highlight several benefits for combining both approaches. That firstly, you will be able to identify high probability trade opportunities, because when you combine both fundamental and momentum analysis, you are able to identify strong trending markets and enter at the right time for the right reason, okay, so that you are able to capture maximum potential. Okay, secondly is that it helps you to avoid false breakouts. So when you combine both technical analysis and fundamental analysis, these 2 ensures that your trades are in line with the overall market sentiment. So this will be able to help you to reduce the risk of jumping into a false breakout driven by noise. Okay, so thirdly, it can improve your trade confidence because when you combine technical signals with fundamental catalysts like economic data, policy changes, and booster, this will be able to boost your overall confidence in order to hold your trading position. And lastly, you can reduce your exposure to unpredictable volatility as well. Okay, because sometimes market shift because of fundamentals as well, so your price swings can be quite unexpected. Now here, if you are able, you can take your phone or to screenshot this page and the next page as well. So here I would like to briefly highlight to you, FKLI, FM70, F4GM, all of these are index futures. Index futures, they are primarily driven by macroeconomic indicators. Okay, so there are plenty and a lot of fundamental indicators. So here I'm just going to highlight a few ones. So if how you are going to use this table, very simple. This is just only for your reference. Okay, so if you look at any of these factors, right, whether is it a strong growth or weak growth, right, so you can just just put a quick tick to see if there is more tick on the bullish side, so it means the price is actually tilt towards an uptrend, favorable towards an uptrend. If there is more tick for you on the right hand side, which is on the bearish signal, so it means the price is actually tends to be weak, and the downtrend may persist a little bit longer. Okay, so of course there will be some challenges in fundamental analysis. Later on, I'm going to explain it to you why. Here is another set of key fundamental factors for commodity futures, especially if you are trading FCPO, FEPO, and FSOI. Now, FCPO, FEPO, and FSOI, all of them are categorized as edible vegetable oil. So the fundamentals that you look at when you trade crude palm oil are similar as the same fundamental factors when you look at soybean oil. So of course, here are just only a quick reference for you. Now, one key challenge in applying fundamental analysis is that sometimes when you read certain news or data, they may suggest bullishness. However, the price may just go the opposite direction. Meaning, when you do your fundamental analysis, you don't just only rely on one individual data alone. You need to gather all of the facts and the data to see that whether all of this data, whether it favors a bullishness or a bearishness. Okay, so when you do fundamental analysis, you need to regularly collect data, regularly, you need to be really diligent in collecting data, reading news, understanding the market, so that you are able to interpret the market accurately, so that you can also align your trading strategies accordingly. Okay, now when you combine fundamental analysis with momentum indicators, so how are you going to do is that you can follow step 1 and step 2 can do interchangeably. You can do your technical analysis first and then only look at fundamental analysis, or you want to do fundamental analysis first and then only to look at your technical analysis, that's fine. Okay, now what you want to do is that let me go through a quick example for you so that you understand how this actually works. Now, this is actually one real life case example, and probably you know when this actually happens. Now, so the scenario actually goes this. Okay, MPO data, it reports a drop in palm oil stockpiles. There is an improvement in export data. At the same time, China also announced stimulus measures to boost economy. This is actually last year. The FCPO price also breaks above 50 days simple moving average. The MACD line is above 0, so this confirms bullish momentum. RSI is also it's actually above 50, okay, not below. Above 50, this also confirms bullish momentum. So what you need to do is actually when there is a lot of confirmation bullishness, you can actually take a long position. And of course, you need to take precaution in terms of managing your risk. All right. So here, you can see breakout. If you draw a horizontal line, you can see there is a breakout. Okay, there is a bullish. Above moving average line is a bullish. MACD, it's above 0 level, it's a bullish. RSI line above 50, it's also bullish. Plus the fundamental factors, many of the fundamentals is also showing bullishness. So you can see all of them actually tilt towards bullish momentum. So you can see the price at that particular vertical dotted line, you can see there would be a strong movement towards an uptrend. Okay, so this is actually how you can incorporate fundamental analysis with your momentum trading. So of course, you need to understand few things. A few things I would like to highlight here is that momentum trading, it's not about blindly following price movements. It's also not mean reversion trading. It's also not counter trend trading, because momentum is that you are actually following the trend and right along together with the trend. It's just that momentum, there will be slow momentum or a fast momentum. So if you are trading fast momentum strategies like the breakout strategies, then it is not a low risk strategies. If you want to, have a lower risk in momentum trading, then you need to use the trend following method. All right. So all in all, besides momentum trading, you need to manage your risk, and there will be some time along this webinar I will be sharing with you what are some specific techniques and strategies that you can actually manage your risk, whether is it doing trend trading and also momentum trading. All right, so to sum it up for today's session is that momentum trading, we have breakout methods, you have trend following, you can do pullback method, or you can also do reversal method when your momentum is actually weakening. So besides that, you can also combine technical indicators and fundamental analysis for your FTLI, FCPO, or those index futures and commodity futures as well. So in short, momentum trading, it's also a form of following the market trends. Never ever go against the trend. And of course, doing momentum trading means you also need to apply risk management to protect your own capital. All right, so that's it for today. Hopefully you learn something on momentum trading. And before we enter into our Q&A session, if you have any questions related to today's webinar session, please type in your questions in Slido so that I can easily capture and address them. While we wait for questions to come in, I would like to ask a small favor from all of you. Please take a minute to fill out this feedback form, since we provide you and quite an informative sharing session for today. So it just takes you less than 1 minute to complete, and you can find the feedback form link in the chat box, or you can scan this QR code with your smartphone. And your feedback is incredibly important to us because it helps us improve future sessions and ensures that we continue deliver high quality content tailored to your learning needs. So please take a quick minute to complete the form, and we will begin the Q&A session shortly. Right, another 30 seconds to go. All right, 1 minute has passed. If you have already submitted your feedback, thank you very much. If you're still completing it, feel free to continue. Now let's move on to the Q&A session. So I see, sir, there are quite a lot of questions on my Q&A Slido box here. So to ensure we cover as much ground as possible, I will select the most relevant questions from Slido and rephrase them for clarity. And please understand that due to time constraints, we may not be able to address all questions. Now, the first question here is whether is momentum trading suitable for beginners? Now, of course, momentum trading is definitely suitable for beginners. Now, it depends on what kind of momentum trading strategies that you are using. Okay, so earlier on I shared with you the 4 types of categories in momentum trading, right? So we have breakout method, we have trend following method, we have pullback, and also the divergence method. So for beginners, I would highly suggest that you use a slow momentum trading strategy, because slow momentum is that the market is still moving slow, it's not fast, and you still can have time to slowly digest the market information, you can still take your time to execute your trade. So I would highly suggest that you start as beginners. Okay, you start with trend following method first. Okay, why? Because trend following method, the momentum is actually is the beginning of a trend only. All right, and during the beginning of a trend, usually the momentum is still picking up only. Okay, it's the momentum is slow, the price movement is small, so you can by the time you make a trading decision to analyze the market, before you even decided to key in your orders, you have sufficient time for you to do all of those things. However, if you are still very new, I strongly do not encourage you to do breakout trading or pullback trading, because breakout trading is actually a high momentum. So during high momentum is that price is actually moving very fast. So price moving fast, volatility is high. So for beginners, you might not be comfortable with the high volatility yet. Okay, so to make it simple for beginners, you can start with trend trading first until and unless you are familiar with the structure of the market, you are quite comfortable with trading, then you can begin to slowly expand your trading strategies to some other forms of momentum trading. Okay. Now the next question is that whether are there any major difference between momentum trading versus trend trading? Now, of course, earlier in the early sessions, I already shared with you, trend trading is actually also part of momentum trading. And momentum trading is also, when you do trend trading, right, there is also momentum. Now, the major difference is that oftentimes when you look at websites, videos, or most people generally, okay, when they speak about momentum trading, even in books, right, momentum trading, usually people are referring to high momentum trading. So which is when the speed is actually fast, the market is actually moving at a fast pace, the trend, there is already a confirmation in trend already. Okay, so it's like when you are trying to riding on a boat, right? So just imagine when the boat is coming towards you, you are trying to hop onto the boat to ride on the trend. So if the momentum is slow, you have time to time the market and then hop onto the boat. But if the boat is actually moving very fast and you try to hop onto the boat, right, too early you fall into the water, too late you also fall into the water. So momentum trading, the primary difference between what people usually refers to momentum trading and trend trading is that momentum trading, usually we refer to high momentum trading. Prices are moving very fast. Immediately, almost you can see price will continue to trend higher or lower within usually is less than a few days or even less than a week. Okay, immediately you can see results. So this is the primary major difference for momentum trading versus trend trading. The next question. Any specific parameters that we use for do I use for moving average, MACD or RSI? Now for moving average, which is a trend following indicator, now there are a few ways that you can use moving average. You can do your back testing for all moving average parameter to find out what is the most which parameter is performing the best, which parameter is the optimal parameter, and you just stick with that individual moving average parameter to trade. So that is what we call as a more of a mechanical method of trading moving average. And there is also another form of trading moving average, is that you can use a standard moving average, 10 days, 20, 50, 100 days. Those are the standard ones. So it depends on what are the specifics. It all boils down to what are the specific strategies that you will be doing for moving average, whether you are doing momentum moving average strategies, whether you are doing trend following, whether you are doing a pullback strategy, and so on. So moving average, you can customize it. Whereas for MACD and RSI, personally, I just only my personal preference, I would prefer to use the default parameter. Why? Is because most of the people in the market, they don't customize their move MACD and RSI. So I use MACD and RSI to look at what is the general sentiment of the market, what others are actually looking at when they use MACD and RSI. So a very simple rule that I have already shared with you just now is that for MACD, you can use whether is it the line is above your zero level or below your zero level. Above zero means bullish, below zero means bearish. RSI, same thing, above 50 it's bullish, below 50 is bearish. All right. Any next question? Any recommended website that compile FCPO fundamental analysis? So far, there is no website that compile whole thing, but you can actually refer to your brokers, futures brokers report, futures trading report. Sometimes they do compile some of the FCPO fundamental analysis from time to time that it's new in the market. Okay, so I think that is the way that you can get the compilation of fundamental analysis quite easily. All right, another because of time, I'm going to pick another one or two questions. Now, next question is whether should we do fundamental analysis first or looking at technical indicators first? Now, this is actually a chicken and egg situation. Which one comes first? Now, to make a long story short is that if you are very new in trading, if you are very new in technical analysis, very new in technical fundamental analysis, I suggest you to start with technical analysis to trade first. Okay, when you're good in technical analysis, proficient with it, then only you look at fundamental analysis. Now, for those of you, if you are really quite proficient in technical analysis, you can start with either technical first. You look at all of the technical indicators to confirm bullishness and bearishness, then only follow up with fundamental analysis to confirm your bullish and bearishness. Okay, you can start with technical first and then fundamentals, or you can start with fundamentals and then technical. Either way, it's also workable. All right. Now, last question. How to spot the trend? Whether is it a late uptrend already? Now, how to spot whether a trend is already almost at the end already? It's actually we will be using the divergence method. So how we spot divergence is actually again we can use MACD or RSI, all of those momentum indicators to look at divergence. Okay, when there is divergence, then it is a possibility that the trend is going to reverse already, but it is not going to reverse yet until and unless the momentum indicator, whether is it RSI or MACD, it falls below the zero line or the 50 level line. Okay, now I see that it's about time to conclude today's webinar session. So let me wrap up today's session. Now, once again, I would like to take a moment to remind you about our upcoming webinars, especially for those who may miss the earlier announcement. Now, the LLF Let's Learn Futures webinar series is a variety of topics scheduled every Tuesday evening from 8:30 to 10 p.m. We will be covering a wide range of content-packed and informative topics where you can gain practical knowledge about futures trading from our experienced speakers. So you can see our next upcoming English topic would be backtest, refine, and profit. Advanced strategies for FKLI and FCPO day traders. This topic is specifically related to day trading. So if you're interested about day trading, you can register yourself for next week session as well. Okay, so if you're interested in joining any of this session, please scan the QR code and register for the topics that you would like to attend. You will be directed to a page where you can access to our event calendar, and to join our upcoming sessions, you can always navigate the Tuesday column on the LLF webinar topic session. Click on the session that you are interested in and proceed with your registration accordingly. In addition to our webinar, we have the online workshop also. This online workshop is tailored for those who are very new in futures market. So if you're interested to learning futures trading in detail, then this online workshop is ideal for you. So take a picture or screenshot this page and register yourself after this webinar ends. And feel free to share this event with your friends and family who are also interested in futures trading. Because in this online workshop, we will be guiding you step by step on how to start trading your first futures contract. And please note that each session is limited to the first 50 online attendees, so be sure to register yourself quickly to secure your seats in both workshop. Again, you will be coming to a calendar, event calendar. So all you need to do is find the Saturday column, click on the workshop session that you are interested in, and proceed with your registration from there. Now, for those of you who may have not already know, you can explore Derivative Trading Simulator in Bursa Marketplace. This is a simulator allowing you to engage with paper trading, helping you to familiarize with how to use a futures trading platform. So you can register yourself for a risk-free trading experience and begin to develop your interest in futures trading. And it's a great way to learn and gain hands-on experience through this trading simulation. And finally, before we conclude this webinar session, allow me to introduce you to Bursa Academy. This is a comprehensive one-stop e-learning platform where you can access all of the information and knowledge about stocks, futures, and other products related to Bursa Malaysia. You can access this Bursa Academy by scanning this QR code on your right or by searching Bursa Academy on Google to find the link. So you can visit this site for detailed information and resources, and it's a valuable resource to enhance your understanding of trading in Bursa Malaysia. All right, we have come to the end of our webinar session for today. And to all of you who joined us, thank you for your participation. I hope you found this webinar both informative and valuable. And I believe you have gained some new knowledge and perspective how you can use momentum trading strategies in trading the futures market better. So there are many categories of momentum trading strategies. You can explore it by yourself. So with that, I am CY signing off now and enjoy the rest of your day. Have a great evening and until next time, goodbye.